Hello, everybody. Welcome to the September Fort Worth HR Benefits and Compensation Peg. And we are super, super excited to talk about a very interesting topic that is very timely and relevant as we enter into fourth quarter. And we brought the best to bring the best information. The topic, understanding medical plan funding options. I'm telling you, this information will help you make better decisions and/or help you question your broker if they're not doing this, because that's what we're here to do, to serve you as the HR directors, the business owners. So without further ado, I'm Doris Friendship, owner of the Benefit Boutique, a small employee benefits firm that focuses on employees, companies that have less than 50 employees. But I brought in the big guns, Geniece Brunson, because she has even international clients. She is my shero. I'm like, okay. All right, so for real, without further ado, I'm going to turn my video off. And if Andrew, if you don't mind turning yours off too, so we can have a great recording, so it won't be any lagging. But I made you co-host, right, Janice?
You did.
Got it? All right, my girl, this virtual floor is yours. And thank you so much for your time.
All right. Can you see my screen? Did I share?
Not yet. No, ma'am.
Okay, let's try this one more time. I've got to hit share.
Okay.
Hey, can you see it now?
Yes, medical plan funding options.
Okay, well, give me just a moment for some housekeeping here. I'm going to clean off my screen so I can actually share my presentation. Okay, are you able to see one of 47?
Yes, we do.
Okay.
We do see the next slide also. And I know.
Hang on. Okay. Let's try one more thing.
That always trips me up too. Right. This is the hardest part. You got all this information, you're brilliant, and we have challenges sharing our screen.
And I can't run it. This computer. Okay, now what do you see?
Now I see the full slide. Perfect.
Okay, medical plan funding options.
Yes, ma'am.
Okay, so I'll just give you guys a brief history. Super brief history about who I am. So I'm a Tennessee girl. I started my career directly out of college. I have a chemistry degree from Tennessee Tech University, the other TTU. And I was going to go to pharmacy school and decided last minute not to go to pharmacy school and was going to be a drug rep because I taught pharmacology at a college level. I compounded drugs all through college. I just loved medicine. And so I ended up thinking I would be a drug rep, but I needed sales experience. Enter insurance. So when I learned exactly what a broker did, I love the challenge. I love understanding. I'm a math person. I love the pharmacy component. And as I shared earlier before we started the recording, I've landed at a company, Epic. Most of you have never even heard of Epic. I hadn't, and I've been in the industry almost 20 years. But we're a California-based company, over $1 billion in revenue, so we're ginormous. We have the best pharmacy team ever, which that was going back to my history. That was very attractive to me. We have 19 pharmacists on staff, handle some of the world's largest pharmacy plans. We have great legal, all of those things. So I'd mentioned earlier, I work for my clients. I'm employed by Epic, but my true calling is to serve my clients. And what that involves is a lot of work, and understanding funding from a medical perspective is super important. And so I'm just going to talk about very high level, the different funding types. But a little history, I gave a little history on myself. Now let's give a little history on insurance. So history of insurance, this is just a fun fact. The first insurance company was based in Charleston, South Carolina. My husband's a South Carolina boy, so this was fun for him to learn. It opened in 1732 for fire coverage. And then Benjamin Franklin started a company, the Philadelphia Contribution Ship of 1752, and they collected contributions for preventing disastrous fires. Okay, the next one is the first employer sponsor plan, which I actually did not know this, but it was in Dallas. So in 1929, a bunch of teachers got together and said, we want to create an insurance company, and they only had Baylor Hospital, which was the network. We always talk about network. So it was Baylor Hospital was their network. And that's why Baylor has one of the best countries HMOs started. It was the first employer sponsor plan. So that's fun. Fun fact for the day. Okay. So I just want to hit on this because there are times, even with my current clients, we get mixed up with contribution. We're not talking about contributions. We're not talking about plan design. Your plan design is your $5,000 deductible. We're not talking about either of those things. Our contribution strategy is what we do once we figure out how we're funding. We give you, this is your fully insured equivalent if you go ASO. This is your fully insured premium. Now let's talk about how we're going to, what kind of contribution strategy we're going to use for the employees and employer cost sharing. We're not talking about those today. So I just want to get that out of the way because sometimes your head will go back to, but wait, what was our deductible? And we are going to talk about deductibles, but we're going to talk about spec deductibles when we hit the ASO and pooling points and all of that. So here, this is a list of our funding arrangement overviews. Now, there are going to be other things because we live in this crazy world of technology and new laws. And so these are the main ones that I will talk to about my current clients. So we have fully insured, which I would say most of you understand fully insured. It's pretty easy to understand. I do have underwriting procedures that I still use with fully insured. We have self-funded ASO. And within self-funded, the ASO, you can have bundled or you can have unbundled. We're going to hit on that. Level funded, that feels like a fully insured plan, but it is filed as a self-funded plan. Reference-based pricing, which we have an expert on here. And then captive and ICRAs. ICRA is a newer thing. I would assume a lot of you have heard of ICRAs, but if you're a smaller company for sure, or if you're a larger company and you're tanking on your premiums because you have a sick, adverse selection, all of that, that might be a good option for you. So when we look at funding by group size, we during the introduction, we talked about like size groups and who's self-funded and who's fully insured. I actually have a slide for this. So this is a national survey based on group size. So for instance, companies that are 50 to 99, 81% of those are fully insured, 19% are self-funded. Now the self-funded could also include level funded, which we're going to talk about in just a minute. Of 1,000 plus, this is kind of surprising. 38% are still fully insured, 1,000 plus. That one kind of gets me, but you know, that's just what they've chosen to do. And it is a business decision, understanding your cash flow. And then of course, 62% of those are self-insured. Okay, this is just a quick picture of the processes for fully insured and self-funded. I've got a little pointer here. Can you guys see my pointer? There we go. So here, right here is our fully insured model. So the employer hires an insurance company and they pay them in premium. The premium is then paid to the insurance carrier, who in turn provides a network, provides ID cards, manages the program, and pays the claims. And then the employees receive the insurance, so the medical pharmacy. They pay their copay and their deductibles, which we're not talking about today. But that is the backbone of a fully insured plan. Down here is a self-funded or an ASO plan. So what happens in this arrangement? The employer hires a carrier. So carrier could be a Buca, Blue, United, Aetna, Cigna, or they hire a TPA. There are tons of TPAs out there. We are very careful about what TPAs we work with. In fact, we just got a new client a couple months ago, and it was a rocky situation with their TPA, and literally overnight they closed their doors. So make sure you know who you're working with from a TPA. We didn't place them. They were not vetted through our company. Nonetheless, we inherited it and they did close their doors. So the carrier would be the Buca, and then you can go outside for the TPA arrangement. And sometimes you can use the TPA within the Buca and carve out everything else. So you pay the admin fee, and then the carrier provides the network, the ID cards, and they will manage your plan. And for managing your plan, you pay your own claims. So in most cases, not all cases, but in most cases, the plan claims are swept weekly from the employer's bank account. And then the employees receive their coverage just as they do up here. So the end game for the employee is no different. You can design your plan from a deductible copay. You do have more, you have you have a lot more freedom within an ASO, which we'll talk about in just a minute, than you would in a fully insured arrangement. But nonetheless, you can pick your plan based on your appetite and your culture. Okay, so let's quickly talk about fully insured. Fully insured is where you have the claims liability put on the carrier. So you pay them a set amount that they give you every month. You pay that into them, they take on the risk. They dictate the plan design, even though I'd mentioned you can choose whatever plan design you want. Within a fully insured market, it's cookie cutter. So there are things you cannot change within your plan. And they adjudicate the claim and the appeals on your behalf. The company has to apply with state insurance laws, and there may be a day we want to have a law session, but there's a lot of responsibility difference from ASO and fully insured where law is concerned. Most compliance matters are the responsibility of the insurance carrier. So you have the RxDC, you have the gag clause, all of this stuff is handled for the most part. They may need to get some information from you, but for the most part, it's handled by the insurance carrier. Employer exchanges risk for predetermined fixed costs. We talked about that's your premium that you pay in every month. And then there is a year-to-year decision based on rates offered. So if I have a client that's fully insured, which I have lots of clients that are fully insured, lots of clients that are ASO, we have them all over the board. I have reference-based pricing, I have all of it. So underwriting considerations, if I get a renewal from an insurance company, I never take what they send me and their talk track. I want to know the pooling point, which is going to be, let's say you have a shock claim out there and it's $300,000. There is a pooling point built into a fully insured plan. I want to know what that number is, and then I want to negotiate anything above that. I want to know my large claimants. It's still important if you're above 50 employees, all of this is negotiable. Now below that's community rated. And so it's not, you can't negotiate because it's based on demographics, but larger clients that are fully insured, I got to know my large claims. I need to know, do you have any information, Mr. Employer, on this set of employees? I want to know when those claims were paid. I want to be able to look back and say, okay, well, we haven't paid anything on this person since February, which our underwriting team can do. So I'm going to take this to market assuming that this claim is over. I still negotiate to that level with my fully insured. I want to understand my loss ratio. A lot of people are under the impression that the carriers are beholden to the 85-15 rule based on one particular client. It's not true. It's based on their block. So they could be taking a client to the cleaners and still be within the law of the 85-15 rule. So just because you're self-funded or fully insured doesn't mean that they are only making 15 percentage points of profit. So what I want to know is, what is your loss ratio looking back 12 months? So a rolling 12 months from when the renewal was released. And then I also want to know a rolling 24 months if we have that data. Are we improving? Are we getting worse? What's driving that? And then I take all of that to market. I want to know participation. Are we dealing with adverse selection? If we are, perhaps we need to get a strategy together to get participation up. So all of those things still play a role if you are fully insured. So still lots of work to do on that. Okay, the next one that I want to talk about is self-funded and ASO. So this is an arrangement where the claims are paid by the plan sponsor, which would be your company, rather than the insurance company. So it's the sweep over that I talked about that happens. Then the insurance carrier, so it's either the BUCA, the major medicals, or a TPA, they will adjudicate the claims on your behalf in exchange for a fee. So the fee is going to be the ASO, administrative services. It's the administration cost. They have a network, more than likely, depending on what your arrangement is. They have condition disease management programs, all kinds of point solutions, which we'll talk about in just a second with my case study. And then services, a lot of these companies have services that they provide, online nurses. So well, you get with Cigna, you're going to get MD Live in the process if that's something that you want to include. And then if one thing to keep in mind, so especially the bundled programs, they want your pharmacy. Um, the bad part or the unfortunate part, it's not bad, it just depends on your setup, is when you carve those out, they can put in your administration and will more than likely a PEPM to carve that out. So the savings could end up being more than the carve out cost. So all of that's important when you're negotiating on the back end on how you're funding your program. And then claims are paid from a plan sponsor, which we talked about, typically weekly. And of course, I've only had one client that didn't purchase aggregate stop loss, but everyone that I've ever had has always purchased stop loss insurance. And that's just your sleep at night. So you're paying all your claims. So what kind of stop loss is available to companies?
Denise, may
Yes,
I ask a question? Why
you
would
sure
they
can.
not buy stop loss?
It's
I don't,
what?
why wouldn't they? What was that one situation? That sounds so
Okay,
key
so
to
it is a strange situation. They're actually reference-based pricing, oddly enough. But it is, they have spec, but they don't have aggregate, and they did it when I became their broker probably 8 years ago. They've never had an ag hit, but it becomes more of a common conversation between us because things are getting expensive. And so they just never had one. And I've actually, in 20 years, this is pretty incredible. I've only had one client that's had an ag hit. It's a rough year.
wow.
It was a rough year
Very
for them.
interesting. Okay.
Yeah,
I was just curious. Okay. Okay, sorry.
that's okay. And you know what? Larger companies have well, not always, may be more cash rich and choose,
Yeah,
it's the world's an oyster for them. If they don't want to
that's what
have it,
I
they
was
don't have
thinking.
to.
They could manage the risk. That
That's right.
gave me anxiety when you said that.
Yeah. Yeah,
So
they
if
can
they
manage
got
the
the
risk
cash, yeah,
and they can manage the risk, and also underwriting has gotten really aggressive. So we have a team of underwriters. I don't do
okay,
a project that I don't include them. So
okay,
like we have pretty good predictive modeling. And so,
okay,
yeah.
yeah,
Yep. Okay. So what are the two types of stop loss? We have specific stop loss and we have aggregate. So specific stop loss covers one person. And it covers, so let's say you and your kids are on the plan. Each of you have your own specific stop loss. So it includes dependents. The deductible is typically determined by the size of the population, which I'm going to show you in just a few minutes what the norms are. The ability to carve out from the medical carriers. You can carve out your spec. I have it both ways currently with clients. And then members with chronic high cost conditions may be assigned a high laser. So if you guys are familiar with laser, if you have someone out there, the stop loss may say, hey, I know you have a 150,000 spec, but this one person is a huge risk. We're going to laser them at 600. So then their spec becomes lasered at 600. You pay the first 600. That sweeps from your account for that one person. And then you have aggregate stop loss. That is what I like to call death by 1,000 paper cuts. So it's everything that falls under, it covers the entire population. It has to exceed a threshold. And I have a picture on how this works because that's worth 1,000 words. But it includes the corridor, attachment point. And so I will show you that in just a moment. Okay, so here's our example of our spec. This is individual. In this case, the employees are covered at $100,000. That's our spec level for this client. So everything under this is covered by the weekly sweep from the employer. Anything over 100, in this case is 50,000, is going to be reimbursed by stop loss. So here, all three of these combined are $700,000 in claim. We have three claimants, so at 100,000 each, the employer cost is 300,000, and the payout for individual spec coming back in the form of reimbursement to the client is 400,000. So that's how the spec works. What are the most common deductibles? I think this is so interesting. But let's say you have, for the most part, if you have, let's say, 299 employees, 64% of those that are self-funded have a deductible spec between 76 and 150,000. If you have 1,000 plus employees, now that can range up to 50,000. So it doesn't, that's a really big sample. But 1,000 plus for the most part are going to be 251 to 500,000. Now I have two clients that are almost the same size. One of them has a spec deductible of 150,000. And then the other one has a spec deductible of 325,000. So it just depends on the CFO, their appetite, their understanding, their risk tolerance. So you really have to do a pretty in-depth underwriting study to see what is going to be the best for my particular company. Okay, you guys stop me if you have questions. Okay, so here's the aggregate stop loss. So this is everything that falls under spec on a cumulative look back. So we start in December. This is how much that we have spent from January through December. This is how much we have spent. So we have our expected claims, which we're going to give you, or you should be getting if you're an ASO. Then you have your aggregate factor. So this is our corridor. So the stop loss insurer estimates expected annual claims. And then the corridor is added. It's usually between 10 and 25%. And then at the end of the year, any claims left over above that will be reimbursed. So this is cumulative. Don't let that confuse you. So this December is the total of the year. So this is the section above the aggregate factor that will be reimbursed. They hit an ag claim. So this is death by 1,000 paper cuts. Okay, so now we're going to talk about claims lag. If you are coming on from a fully insured, you got to know your lag anyways. But especially if you're coming on from a fully insured to a self-funded plan, who's paying the first 3 to 4 months of claims is going to be the previous provider. So let's say you go to the doctor in December, date of service is December 20th. They're not filing it that day. It's not paid that day. So we have 3 or 4 months where our plan isn't paying anything. That's when you start reserving your cash. You're funding your bank account to be swept. And then here, this is just an example. We have a claim that's incurred on 7/1 and it's paid here maybe August. So that's our claims lag. So we're able to put a number to how you're performing and what the term that we use is called IBNR, what your incurred but not reported is. And then on the end here, you have a reserve. So when you're building your policy, it's very important to understand your stop loss contract. In this particular case, I would probably do a 12/12 contract with the TLO in case it's the terminal liability in case you need to go back fully insured. However, we get through our 12/12 contract, we're going to reevaluate and restructure our contract based on, how much our run out needs to be. So all of these things are very important when you're building your stop loss. So I'm going to be referring back to this a little bit as we talk. Okay, pros and cons. So benefits and considerations. In general, lower cost. It just depends on how you're performing. And then you're going to have good years and you're going to have bad years. You're not going to win every year. More control over the plan. So you're not limited to the cookie cutters I talked about from a fully insured. You have greater flexibility in who you choose to be your TPA. There's a lot more out there. And you're exempt from state mandate insurance requirements. You have a potential to benefit from improved population, the greater access to plan data, which is so important. If you can get your data, there's so much power in data. I can go 50 different directions as to why I want to understand my client's data. There's a one-time cash flow gain, which is the chart I just showed you. So that run in an immature plan year is what we call that. Allows less risk to adverse plan sponsors. The ability to carve out stop loss if you want to do that. Remember, it's built in on a fully insured, calling the pulling point. And then pharmacy rebates. There's a lot of non-transparency in pharmacy right now. So understanding your pharmacy is important, and having a good pharmacy vendor is very important to represent you. So that could be passed to the employer, the rebates can, or they can be considered through a reduction in your ASO fee. Considerations, potentially the cons, potential higher cost if you're not running well, month to month fluctuations in claims that are being swept. It's not that monthly premium from a fully insured perspective. Increase employer responsibility. You have access to HIPAA. You got to know how to handle that. There's some more fiduciary responsibilities. I have a client right now trying to decide, are they going to cover gender, um, what is it called? Gender re, the word just left me, reassignment.
Gender affirming care.
There you
Gender
go.
affirming care.
Yeah. So are we going to cover gender reassignment in our plan? By law, right now, you don't have to, but court cases are being won on the employee's behalf. You have to make those decisions when you're going into a self-funded plan. So there's a lot of responsibility in that as well. And I have a client now, they also self-fund their disability. They're large enough to do that. So now do we cover it there? So I mean, it's a lot of understanding, what is our liability? And then of course, I've talked about IBNR. We got to understand our IBNR and our actuaries take care of all that. So okay, level funded. I'm going to talk quickly. I'm running out of time. Okay, level funded. I don't love level funded. I want to, and I still have clients in it because it's hard to get out when you get in because there's that cost sharing at the end. But in a nutshell, it is filed as a self-funded plan. You have to pay your PCORI fees. 87% of my gray hair has come from negotiating level funded arrangements. There's a reason Cigna is getting out of the fully insured business in New Mexico, which is where and I actually just got a new client in New Mexico, but I have 2 clients in Albuquerque on level funded. Fully insured is not even an option anymore, because insurance companies are making a killing off of this and brokers do not understand it. So here's what happens on the back end if you're in a fully insured arrangement or in a level funded arrangement. The carrier, even if you ask them not to, will come at you with expected claims versus paid claims. It's this yellow section here. What they're not telling you about is this admin cost. So they come at you and they say this client is running 140% of expected. Oh my gosh, well, they should get a 30% increase. No, they're not running 140% loss ratio. So what are you doing with all this money, Mr. Insurer? And so it's pulling apart. In fact, I worked with our underwriting team and we have a platform now for our level funded clients because it's not really ASO and it's not fully insured. So when they go, let's say you get them where they need to be from a loss ratio perspective, make sure they're not putting all of that increase on fixed cost because you're not getting that back. And that's the whole grand thing about level funded is at the end, there's an opportunity for surplus. If you have a surplus, it's usually a credit in the next year, so you do have to stay on the platform. So if you guys have any questions about that, call me. We have a one-off or lunch or something. Underwriting considerations I've mentioned, ISL. How many people are hitting the ISL? It is a self-funded plan. I have to know these things. How much are you making on fixed costs? What is our surplus? And what is the claims funding? All of those are so important. And I would approach them differently. Okay, reference-based pricing. This is a ASO, self-funding arrangement. Cost savings are on the large claims, and we know that 80% of premiums are spent by 20% of the employees. It is an effective model. I do have clients on RBP, and there's transparency. There isn't always a network. In some cases, there is a network. You can wrap networks. I would say the worst part of this, it's a culture thing. And if you can get in front of your employees and say, hey, you could possibly be balance billed, even though you're paying for your insurance, but hang tight because we have someone negotiating that on your behalf and they're keeping your rates down. So the risk is balance billing. And then we don't always experience this, but have in the past limited access to some providers not wanting to see patients because they are not in the network. That's very rare that happens, but it has happened. And I have a client right now that has no network at all. They don't have a wrap or anything. It works well for them. We can't find anything more competitive in the market. It's already an ASO situation. So I feel like maybe not enough people are talking about reference-based pricing, and I think if you approach it in the appropriate way, it could be a really great tool to control cost. Okay, captives. We have our captive, we have transitional insurance. So this is going to be a fully insured situation we talked about initially. Business owner pays a premium to the insurance company pays the claims to the doctors and hospitals. The profits, if there are any, or losses, go back to the insurance company. In a captive arrangement, not always. Generally speaking, in a captive arrangement, the business owners pay a premium to the group captive, pays the premium to the claims, the profit goes back to the business owner. Not all captives provide dividends. The thing that couldn't stress more is understand your captive manager. How are they running? Understand your stop loss policy. Understand the back end of a captive. I think it can be effective, but there is that extra layer now of people involved in your plan, or I guess you could say you're involved in their plan. So here's our traditional stop loss. We have stop loss policy layer, our spec deductible, and then plan design, basically the employee share. Here's what it looks like in a captive. You have your stop loss policy layer, and it's a little bit higher. So this might be a $100,000 spec, and this might be a $300,000 spec. How do you make up the difference? That's your captive layer. So they will say, join our captive in hopes to spread the risk um, horizontally with other companies. Then you have your stop loss layer on top of that. Okay, the last one I'm going to talk about, I'm talking fast. I feel like every time I do a presentation for Fort Worth HR, I have to talk really fast. This is a newer design. This came about in January of 2020 was the first time anyone or any group was able to have an ICRA. And so I know some of you that handle smaller companies may like this idea. I don't know how familiar you are with it. We have a company that we've vetted that I really do like. So if any of you need contacts, um, let me know. I'll send you my contact. The company is Zizzle. I think they do a great job. But what is an ICRA? It's an individual coverage health reimbursement arrangement. It's going to reimburse your employees pre-tax monies and they pick their plan. So basically, Zizzle will, or whoever you use, it doesn't have to be Zizzle. They provide the plan designs. The employee picks it, their plan that they want. So it's not a $5,000 deductible. You want a $500 deductible? That's great. Pay for it. These are individual plans. They are not based on pre-existing. They are not based on utilization. It is community rated individual plans. So this can be a really good thing for a company that has terrible, utilization or just wants a different way to do their benefits. So the employer funds the actual HRA. So keep in mind, if you do this is a self-funded arrangement and you got to pay your PCORI fee. Such a side note. And then the employee buys the plan that they want. The employees either waive the HRA or they use the money to buy the plan. And there's some more other nuances that we can go into, not today because I'm running out of time. But here's the landscape of what it looks like. The employer determines how much they want to pay. The enrollment happens. The employee either enrolls or waives. The carrier, and in this instance, Zizzle is who we've used. Behind the scenes, they handle enrollment information, payment information. They send things directly to the carriers on behalf of the employees. We have had carrier outreach, but it's fine. We can intervene and let them know the premiums are being paid, and they will find that they have been. They do have year-round support, which is nice because you don't want to do the admin on this. And then open enrollment's very different. So you're not getting a renewal like you would from Blue or whoever you're with. It's a very different process. And then how premiums are calculated, I've already hit on that. It's community rated, guaranteed coverage, not pre-existing. The individual premium is demographic based.